Hello, everybody. Ed Denny here from Des Moines, Iowa. I'm going to be speaking tomorrow at a conference of investors who invest in land, farmland, forests, recreational land from all around the world. So that should be interesting. And I haven't really focused on land as an asset class, but kind of makes sense if, particularly if you're an institutional investor. But today's news, of course, is disturbing, terrible, awful, and that's that the administration is going after Jerome Powell for perjuring himself in testimony before Congress, something having to do with the fact that the reconstruction costs on the Fed building is well above budget. I think it's clear that it's very political. It's so political that Powell just couldn't hold back anymore, and he put out a statement saying that it's political. So he's not going to suddenly roll over. I think the administration is going to get some really heavy-duty pushback on what they're doing here with the Fed, the Fed's independence, and their investigation of Powell. I think almost all of us would agree that Powell has done a reasonably good job under the circumstances. He got us through some pretty harrowing times, and I think he's a straight shooter. So this is not going to play well. It seems that the administration is kind of running scared about the midterm elections. The midterm elections may not go the way of the Republicans, and Trump has said a few times that if the Democrats get the House, then he'll be impeached by them, and that would obviously take a lot of his powers away and take his focus away. And right now, I think he feels like he's on a roll with some of his foreign policies. The problem is that the issue that the midterms will probably be determined on will be affordability, and I think he's trying to present the attack on the Fed, specifically on Powell, as an attempt to bring down interest rates and make things more affordable for Americans. He also came up with this idea of putting a cap of 10% on credit cards. And here we all thought that this administration was going to be against regulations. They were going to promote deregulation. And they're talking about regulating the interest charge that banks can apply on credit cards, and so that's got the banks spooked. I still think that the earnings season this later this week is going to be so strong that they'll make a comeback. Also, it's not clear to me that the administration has the regulatory power to impose a cap on interest rates charged on credit cards, but it will be something that will be tested. There will be obviously pushback from the lobbyists of the banks, and they got some very good, powerful lobbyists. They pay them a lot, so I don't know if that will actually occur. But got to say, it's every day there's something new, and every day the market seems to be able to overcome these things. Anytime there's something new turns out to be cause the stock market to go down, we get buyers coming in, and that's largely because earnings have been so good. Let me let me get right down to the charts. I don't want to make this a kind of a long-winded monologue, so let's make it a little bit more chart oriented this time. So here we go with the charts, and I'm going to look at quick takes and at quick takes and today's morning briefing. So the basic notion is the economy is resilient, earnings are resilient. Looks like the fourth quarter earnings reporting season is going to go very well. Let's look at some of the charts that are relevant to that. So here, from the quick takes that I did this yesterday, um, you can see the S&P 500 quarterly EPS, the actual earnings number are the blue lines, and then the red line, that's quarterly data. So I think that revenues are going to be at an all-time record high when we get the readings for the fourth quarter. And as you can see, the weekly indicator of S&P 500 forward earnings is in fact at an all-time record high. And if you put a little magnifying glass to it, you'll see that the pace at which it's increasing is it's accelerating. It's going up at a faster pace. And I think that forward earnings is a very good coincident indicator of the economy. So it's telling me that the economy is doing very well. Uh, let's see what I did here. Okay, we're gonna go to the morning briefing. Here we go. So let's go to the morning briefing, and what you see here is that the Fed officials, when he asked them what they think the long run growth rate of real GDP is, you can see what they tell you is 1.8%. That's the average of the 19 participants of the FOMC, and it goes back a few years, and you can see that they have been too creative in thinking of what the longer run is. And 1.8%, well, we've been doing certainly did better than that last year, and we should continue to be able to do better than that this year. But I think if their number is wrong, it'll be because productivity is pretty strong. They're probably estimating the productivity is going to be up 1% and the labor force is going to be up 0.8%, and that would give us real GDP of 1.8%. I think productivity is going to be up a lot more than that, and that the as a result, the economy will be stronger because of the productivity. This is the real gross domestic product, year-over-year percent change through the third quarter. On a year-over-year basis, it was up 2.3% on a year-over-year basis. And I think it's a good way to look at real GDP. And we're thinking that it could be 3.5% this year, maybe as much as 4%, depending on how the productivity story plays out. And it was very strong in 2025, and we think it'll continue to be very strong during the current year. You can see the average over time for real GDP is 3.1%. You can see that the recent average has been weaker than that. It's been 2.1%. So it's true that over the past few years, we've had a slower growth rate in real GDP, but just because that's been the case doesn't mean that it's locked in. It is locked in, I think, to a large extent from the growth rate of the labor force, which is likely to remain really low as baby boomers retire. But as we'll see in a minute, the labor force isn't growth isn't quite as weak as generally assumed. This is the output measure that is used in calculating productivity. The output measure is very similar to real GDP. It's real non-farm business output, and as you can see, its growth in uh, in the third quarter was year over year 2.8%. The output average over time has been 3.4%, so that's better than real GDP, as you can see from this chart. So it's real output that goes into calculating productivity, which makes sense. This is how we measure productivity. Productivity is real output, which we just looked at, and we think it's growing better. But productivity is real output divided by labor input, by labor hours. And as you can see, these two alternative measures of labor hours have flattened out. Certainly, the quarterly number that goes into productivity has flattened out for the past two quarters, second and third quarters is what we have. And then we have a monthly series called aggregate weekly hours worked, and that's based on total payroll employment and the number of hours that all those people are working in billions of hours. Yeah, I mean, you can see that we work a lot. We work 4.7 billion hours is the aggregate that's aggregate weekly hours. Another related measure, of course, is in fact payroll employment. So it's labor hours is payroll employment times the average work week. And we all know that there's definitely been something funky going on with the labor market. Payroll employment has definitely slowed down. This is the average weekly hours, and you can see that it's been extremely volatile here, basically flat. But although we did have an increase in payroll employment to 50,000 in December, that was more than offset by the drop in the work week. But the drop in the work week is, what can you say? I mean, it's just going nowhere fast with a lot of volatility. Um, this is the labor force. As you can see, it's on a year-over-year percent change basis. It's not 0.8, it's 1.8%. If you look at the yearly percent change of the 12-month average, it's 1.3%. So it's also tends to be volatile. You have to kind of smooth it out. And even when you smooth it out, it tends to jump around. A lot of factors influence the labor force. But I think we can basically count on something like 1% growth in the labor force this year. Add 3% growth in productivity, you get 4%. Add the historical average for productivity has been 2%. So add just 2%, you get 3%. We're not growing at 1.8%. We're growing at least at 3% in our roaring 2020 scenario, where productivity started to clearly boom last year and continues to boom this year. We can obviously get more real growth. This is another slice and dice, by the way, of the labor force. And I think a lot of people think that the labor force is actually declining. It's not. The red line is the year-over-year percent change in the labor force. It's up 1.3%. The foreign-born is down to 1.8%. It's still a positive number. It's still growing on a year-over-year basis, but it's down from 6%. So you can see this was when the border was wide open, a tremendous increase in the foreign-born. And of course, not all these foreign-borns are illegal immigrants. There's a lot of people who are born overseas and are legitimate citizens and so on. So I think there's more life in the growth rate of the labor force, which, by the way, means we might actually see some pickup in payroll employment. Maybe some of this weakness in payroll employment, it all kind of started in April, which seemed to coincide with Trump's reciprocal tariffs. It seemed to coincide with Doge. And maybe as those issues wear off, we'll see better payroll employment. Right now, everybody seems to agree that we've got a new normal for payroll employment, that something like 50,000 to 60,000 per month is enough to keep the unemployment rate around current levels. And the unemployment rate came down from 4.6% to 4.4%. But now here's the good stuff. This is it's all good stuff, but productivity increased 4.8%. As you can see, it's pretty volatile quarter to quarter. It's less so when you do year over year. Year over year, it's not quite as impressive. It's 1.9%, which is kind of back to historical norm. But again, we're thinking that you look at this kind of clump here of strong productivity. We think we're going to have more of that up ahead here. Okay, so if we get better than expected productivity in the roaring 2020s, then we'll get downward pressure on inflation, because unit labor costs is equal to hourly compensation, which is the broadest measure of compensation that's available quarterly. And so if you divide unit labor costs or hourly compensation by productivity, you get unit labor costs. And as you can see, this is highly correlated with the CPI, which makes sense since it's clearly the case that unit labor costs are the underlying inflation rate in the labor market. So I do think we're going to see 2% inflation th this year. Let's move on here. This is a very controversial subject, and that is, okay, so productivity is doing better, but workers aren't doing better, and they should be doing better because I think we all have a sense that in a competitive market, that workers should be paid their real productivity, or real wages should be equal to productivity. And you can see that, in fact, that's what has been the case. But you need to get this relationship, you need to divide hourly compensation by non-farm business deflator. In other words, the prices that companies themselves charge, not overall prices. You know, if I'm an employer, an employee comes to me and says the price of gasoline has gone up a lot, I need a pay raise. My response is, you know, we don't make gasoline, we don't price it. Here's what we price, and here's the price that this company gets for its profits. And that's consistent with the microeconomic theory that says real productivity should determine real wages. The question is, how do you determine real wages? What price index do you take? But I'm taking the one that theoretically makes sense, and it does make sense that on balance, workers do get paid their productivity from their employers. This is another measure of real wages. There's lots of misinformation on this particular chart. This is average hourly earnings that's available monthly. And what you can see is that it's been rising fairly steadily, not steadily, but on a trend that's about 1% per year. And during during the pandemic, real wages rose faster than that. Then, when the pandemic abated, real wages grew somewhat less than that. But now we're back on that trend. I'm thinking that real wages, the growth rate of real wages, will actually increase from 1% maybe to 1.5% as a result of the productivity. So that's important because if we have fewer workers, we have fewer consumers coming into the marketplace. Then we have question mark as so where's the purchasing power? Well, it's got to be coming from real wages. But wait, I'm holding something in abeyance to sort of ace up my sleeve. But a lot of people have suddenly been worrying about this number here. This is disposable income. This is disposable income divided by the CPI. And as you can see, it's gone flat. So how can the consumer keep spending if the payroll count and the hours worked have flattened out, and real wages really haven't picked up more from their historical trend? What's keeping the economy growing? And no surprise to those of you who've been following my work, the answer is $85 trillion, $85 trillion of net worth of the baby boomers. When they were young, they didn't have much in the way of net worth. They've lived long and prosper, as Spock told them to do. And so now they're sitting on $85 trillion. It's the wealthiest retiring generation of all times. And I've called this whole thing kind of the Gen shaped economy. A lot of people call this economy the K-shaped economy. There's winners and there's losers. There are high incomes and low incomes, and the rich are getting richer and the poor are getting poorer. There's a lot to that. I'm not denying any of that. But I'm saying that that also completely ignores that demography may have something to do with the so-called K-shaped economy. It's really, from that perspective, more of a generation-shaped economy. And what I see happening is that the baby boomers are retiring, and that means their disposable income goes to zero. They're not getting a paycheck anymore. Meanwhile, they're spending their nest egg. In that scenario, you would think that their net worth would go down, but if the stock market keeps going up, because everything is working out well for the economy and earnings, then they spend money, and yet their portfolios don't go down much, if at all. Maybe some portfolios actually go up. And then I do anecdotally see a lot of intergenerational support between the baby boomers and their young adult children, and helping out with supporting some of the grandchildren. And I've looked at some studies on it, and the studies tend to confirm that that's kind of going on. And that wasn't the case when the baby boomers were young. They didn't get that kind of huge windfall. Again, the baby boomers have a lot of money in the equity market, and if the equity market keeps going up, that'll keep them spending. I guess then the risk is that the equity market will go down, and if it goes down a lot, maybe they'll retrench, and that'll cause a recession. We give that 20% odds at this point. We're not denying that's possible, but it's not our base case. Our base case is a 60% roaring 2020s, 20% 20% melt up, melt down, and 20% that things just go awry. Meanwhile, things aren't going awry for real GDP in the fourth quarter. Productivity could very well be up again very substantially in the fourth quarter because the imports, as you can see in this chart, went down a lot. Exports went up some. The trade deficit narrowed, and that's boosting the estimate for real GDP growth. The Atlanta Fed's tracking model has real GDP in the fourth quarter growing 5.1%. I mean, I can't imagine that number is going to hold. That I think there's going to be some lowering of that number. I mean, it's an amazing number, but well, let's see how it goes. But all in all, it looks as though we've got second, third, fourth quarters real GDP very strong, productivity very strong because labor input is very weak. Again, we looked at the real. We looked at the forward revenues of the S&P 500 all-time record high. This is the forward earnings of the S&P 500 all-time record high. And look at that slope. It's actually picking up. And I've got a chart showing, not here, but a chart showing the forward earnings versus the index of coincident economic indicators, and they're very similar. And this is supporting the idea that the economy not only was strong in 2025, but actually might have been improving as we got into the fourth quarter. This is that forward. This is forward earnings versus what was that? This is forward operating earnings. Okay, this is the same chart basically. Yeah. Okay. Then the other big story is the profit margin. This series is kind of confirming the productivity story, in my opinion. If productivity really is making a comeback here, you would think that it would benefit profits through the profit margin, and the forward profit margin on a weekly basis is at an all-time record high. And all this data for the fourth quarter we're going to get shortly. We don't need to get into this chart. Let me get into some of the questions that you folks have. Let me just open up the. Okay. So, John, which emerging markets do you like? I like EMXC. EMXC is the emerging markets ETF, excluding China. I mean, we just don't have the time or the resources to give you specific countries. I mean, Mexico, Brazil, they've got their pluses and minuses. Uh, India has had a huge run a year ago, and now last year it kind of consolidated. Indonesia, Malaysia. Obviously, a lot of the strength in the emerging markets index has been Southeast Asia, particularly Korea and Taiwan. Okay, Gary. Ed, with high valuations, world and administration getting a little more crazy. A little more crazy? Gary, it's a lot more crazy. Uh, 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 and each day and every strategist positive, does it make sense to tactically underweight equities and keep some dry powder for better opportunities? Just feel like something out of left field is coming, major sell-off. Yeah, well, we've been thinking that it could be kind of a choppy first half of the year, and thinking that this Fed issue would be a source of choppiness, but didn't expect that the administration would do what they're doing now, which makes it somewhat choppier. The market seems to be handling it pretty well. It's obviously very bullish for gold. Gold has really taken off on it. So I don't know. I think if you've got some overweight in gold, that kind of gives you some balance in the portfolio for equities. Anything that makes the equities go down is probably going to be good for precious metals, generally speaking. Uh, the financials just got reminded that even this administration, which is supposed to deregulate financials for political reasons, might decide to uh, put more regulations on financials. But financials are kind of, and fintech all make sense. Industrials make sense. But yeah, sure. I kind of had that same queasy feeling that we've had such a great run here that something could knock us off this great run we've had. But it's up to you. Lee, does the generational wealth difference actually contribute to the apparent increase in productivity insofar as there is a large spending population that doesn't actually impact the hours worked in the equation to calculate productivity? And if true, doesn't that bode rather negatively to the economy? Well, productivity is output over labor input, and clearly the when the baby boomers retire, as they retire, that's weighing down on the labor force growth. So they're weighing down that, and at the same time, they're keeping their consumption going by spending their nest eggs. That boosts GDP. So as I read it that way, real GDP is growing solidly thanks to the baby boomer spending, both on themselves and on their young adult children. At the same time, the labor force isn't growing as much because the baby boomers are retiring. That's a great story for productivity. Okay, William. Let me see what time it is. Consumer staples are leading the pack plus 3.3% and beating the S&P 500 by 150 basis points year to date. Early, yes, but why? Um, yeah, it's a good question. I think clearly there's some risk offs. People want to be in the market, but it's had a heck of a move. Maybe some of this is indicating that technology and communication services might not perform as well because of competitive pressures there. Um, the and meanwhile, the consumers are still spending. So I guess those are just some explanations. But William will have a closer look at that point. Honestly, I haven't done my homework on that as much as I should have, but I will. Thanks. Um, can't do this without you folks giving us some direction. Are concerns about valuation being too high just justified? Well, we've discussed this a few times that a 22 valuation multiple is certainly high. Is it too high? It's too high if there's going to be a recession in the next 6 months, next 12 months. If there's fears of a recession, there could be a correction. So that would bring the valuation multiples down. Usually, almost always, corrections occur because something happens that convinces investors that a recession could happen. And if it doesn't happen, it's a correction, 10 to 20% down. If the recession does happen, you get not only the valuation multiple going down, but also earnings going down. So you get a bear market. So I don't really have a problem with where valuations are today. This is where they were about 6 months after the pandemic. And yet, since then, the S&P 500 is up 100% because earnings are up 100%. So I think the key is, are we going to have a recession between now and the end of the decade? Um, and I've been arguing during the beginning of the roaring 2020s that we might not have a recession. My counter instincts came out when I concluded that it was the most widely anticipated recession of all times that just wasn't happening. and wasn't likely to happen because I thought baby boomer consumers would spend. I thought capital spending on technology would be strong, and I thought the federal deficit wasn't going to go away. So all that meant the economy has been strong so far. And so why don't we learn from our recent experience and conclude that maybe the economy will continue to be resilient through the end of the year? And I think that's what the market's kind of discounting in the valuation multiple. Investors aren't that spooked about these valuation multiples if they've come around to our view that the economy is not going to have a recession. It doesn't come with a money back guarantee, and I give you a 20% probability that we could have a recession this year or make it the rest of the decade. I'll take a couple more questions and then we'll give it a rest. Weston, any thoughts on earnings growth broadening out beyond just tech mega seven? How about mid caps given lower rates? Yeah, we've been working on that as well and pointing out that the earnings of the 493, the S&P 493, have been going up. They are in record territory. They're the I call them the impressive 493 because they're not as magnificent as the Magnificent Seven, but they've generated very solid earnings growth and should continue to do so, and may actually see more of an acceleration there if this productivity story is playing out. I mean, you're not going to get better than expected productivity just because seven companies are doing well. What they sell that enhances productivity, the technologies that they offer are productivity enhancing, and they do apply to 493 and other companies. Mid cap should be affected as well. However, when I look at the forward earnings of the mid caps, they still kind of look like they're flatlining. Past few weeks, they've looked like they're starting to pick up, and the market seems to have been anticipating that. But the one reason I think the mid caps are having a problem is because any really, really great mid cap company with amazing prospects is probably going to be bought out by a large cap company. Um, Finally, let's see, Weston again. Is your biggest risk some type of embargo invasion of Taiwan emboldened by Venezuela? If not, what's your biggest risk for 2026? Good question, and I guess we're like-minded. I've been exactly thinking about that issue, is the geopolitical consequences of Venezuela, of the Don Roe uh, doctrine, the Monroe doctrine as applied by President Trump, that it could very well uh, cause the Chinese to blockade and maybe even invade Taiwan. That would be the event that the previous questioner may find is most unsettling. Um, but other than that, I've been concerned. As I said, I mentioned the volatility from the Trump's move against the independence of the Fed. The bond vigilantes might get concerned if the economy starts to really show continuing strength because of excessively stimulative monetary and fiscal policies. So lots to think about, lots for us to research, more subjects that we will research. I want to thank you all for joining me. We had a nice turnout here, coming you from Des Moines, Iowa. Weather is 51 degrees and sunny, so I'm looking forward to taking a little walk. Thank you, everybody.